Welcome to Smart Wealth Plan. Simple, smart money management. If you panic sell because of war headlines, you may be making the exact mistake markets have punished investors for over the last 100 years. So what actually happens to stock markets during war? Let's look at the evidence. Today's reaction follows a classic pattern. Oil surged more than 13%. Gold jumped around 2.5%. And stock markets fell as investors rushed to reduce risk. This is the typical first reaction to geopolitical shocks. The real risk isn't simply the war headline, it's energy. Around 1/5 of global oil supply moves through the Strait of Hormuz. If conflict disrupts that shipping route, oil prices can rise sharply. And when energy prices spike, inflation often rises with them. The impact also differs between countries. The UK is more exposed to global energy prices, which can push inflation higher and delay interest rate cuts. The United States has a large domestic energy sector, so higher oil prices can actually benefit some parts of the market. So the same geopolitical shock can affect markets very differently. Historically, markets often follow a predictable pattern. First comes the shock, then markets stabilize, and finally investors reprice assets based on inflation, interest rates, and corporate earnings. War headlines rarely determine long-term market direction on their own. So here's the key question. If oil prices settle back after the initial spike, markets usually stabilize and refocus on economic fundamentals. But if oil stays elevated and supply disruptions continue, inflation could rise again and delay interest rate cuts. And that's when markets can face more sustained pressure. So these are the 3 signals investors should watch closely. Oil prices, inflation expectations, and interest rate policy. Those factors matter far more than the headline itself. So what are you doing right now? Selling stocks or holding through the volatility? Let me know in the comments. And subscribe to Smart Wealth Plan for clear, evidence-based investing insights.